Welcome to the Economist in Your Ear podcast. Is the American economy truly defying gloomy expectations, or are we perhaps only seeing part of the picture? And what might that mean for you and your financial outlook? For what feels like ages, there's been this persistent drumbeat of worry surrounding the U.S. economy. You've heard the chatter, right?
Oh, absolutely. Concerns about sluggish job figures, the lingering uncertainty of tariffs.
Exactly. All leading many to anticipate, a significant downturn. But here's where it gets really interesting. Despite those persistent concerns, the American economy is actually painting a far more complex and surprisingly resilient picture.
It appears to be slowing down, yes, but critically it's not collapsing.
Right. And today we're not just reporting on these trends, we're dissecting the very arguments that suggest resilience, and then we're going to challenge some of the underlying assumptions to give you a truly rounded perspective.
Looking beyond the headlines.
Precisely. The raw numbers offer a compelling initial argument for this resilience. Take GDP growth. The first half of 2025 saw a modest 1.4% annualized rate, which might sound a little tepid.
Bit sluggish, yeah.
But then it roared back in the second quarter, hitting an impressive 3.3% annual rate.
Quite a jump.
And the financial markets. They've offered a curious dichotomy. Treasury yields have slumped, often a sign of slower growth or impending cuts. Yet stocks, especially those riding the AI wave, are actually hitting all-time highs.
It's almost as if Wall Street is whispering one thing while some economic data hums another.
It feels that way. And for you, the everyday consumer, spending hasn't evaporated. July retail sales edged up 0.5% month over month.
Which translates to, nearly 4% year over year nominally?
3.9%, yeah. So this suggests continued, albeit perhaps more deliberate, spending. Even the labor market, which was a source of early anxieties, shows unemployment at 4.3% in August, with 22,000 payroll additions.
Which is not a huge number, admittedly.
No, but it doesn't scream crisis. It suggests a cooling, a gentle deceleration, rather than a hard stop. It's a nuanced snapshot, one that demands a closer look.
Okay,
let's unpack this slowdown even further and examine what this optimistic narrative seems to be getting right. When we look at GDP, that 1.4% annualized growth rate in the first half of 2025, while not blockbuster, isn't a disaster either.
No, not at all.
But the real story is that Q2 rebound to a 3.3% annual rate. Think about that for a moment. We went from a modest pace to a solid expansion within a single quarter.
And crucially, if you compare that to what's happening across the pond in Europe, where growth has been far more anemic.
Right, the U.S. picture looks quite robust in comparison.
Definitely.
What's even more compelling for this slow grind narrative is how current forecasts are shaping up. The Atlanta Fed's GDP Now tracker, which gives us a real-time dynamic estimate of economic activity.
A useful tool.
It projects Q3 private domestic demand running above 2% annualized. Now, if that holds steady, especially alongside relatively flat payroll growth, it really bolsters the idea that we're on a managed glide path, not heading for a sudden cliff edge.
So the economy isn't sprinting, but it's certainly not stalling either.
That seems to be the takeaway. Another fascinating aspect here is how financial markets are interpreting all of this. Treasury yields have continued to drift lower. And frankly, bond futures are actually implying a series of rate cuts coming from the Federal Reserve in September, October, and December.
Which usually points towards economic weakness, doesn't it?
Typically, yes.
Yeah.
Lower yields, anticipated rate cuts. You'd expect maybe more worry. But juxtapose that with stocks hitting all-time highs, particularly those big tech and AI companies.
So this doesn't signal fear of an impending recession, does it?
It really doesn't seem to.
Yeah.
It's more like the market expressing confidence that the Federal Reserve is navigating an easing period effectively, potentially achieving that elusive soft landing, rather than staring down a crisis.
Investors are clearly betting on a managed slowdown, not a dramatic crash.
Seems like it.
Yeah.
And what about us, the engine of so much economic activity, the consumers? Despite all the headlines and cautious sentiment, the July figures show real household consumption ticking up again after a somewhat sluggish start to the year.
Right.
Retail sales have remained surprisingly solid month after month, and surveys gauging activity in the service sector show a consistent positive trend.
So this isn't the picture of consumption cracking under pressure, which is often a precursor to a downturn.
Exactly. It's more like still spending, just perhaps a little more cautiously, which is an incredibly important distinction.
A subtle but vital one.
It means that while you might be thinking twice about that big purchase, you're still participating in the economy, keeping the wheels turning, even if at a slightly slower pace.
Okay. And the labor market. You mentioned the low payroll number.
Right, even the labor market, which initially seemed to be a source of gloom for many forecasters, reveals some important nuances upon closer inspection. August payrolls added a modest 22,000 jobs, unemployment at 4.3%.
Not exactly setting the world on fire.
No, and some might see that low payroll number as a red flag. However, when we look at JOLTS data, that's the Job Openings and Labor Turnover Survey, which gives us a deeper look into the supply and demand for labor, we see something different.
Okay, what's that showing?
Job openings are indeed down from their peak, and people aren't quitting their jobs at the same frenetic rates we saw earlier.
Ah, the Great Resignation cooling off.
Pretty much. What does this tell us? It suggests a market that's cooling, becoming more balanced rather than collapsing.
So moderation, not meltdown.
Precisely. In fact, if you look at two key markers of labor market slack, the ratio of job openings to unemployed people and the job quitting rate, they're surprisingly similar to levels we observed in the late 2010s.
A period many consider to be one of steady, sustainable growth.
Exactly. So while the pace is certainly moderated, the underlying structure appears quite stable.
Okay, it's true that the initial data points paint a picture of surprising resilience, but to truly understand where we stand, I think it's essential to look beyond the surface and, challenge some of the underlying assumptions.
Let's do it. Where do we start?
Well, take the argument about migration and jobs. The article suggests that fewer migrants mean fewer jobs are needed to keep unemployment stable, leading to a lower break-even job number.
Okay, that makes accounting sense.
It does, in a purely accounting sense. However, the data for net migration in the U.S. is notoriously noisy and uncertain, making it difficult to rely on for precise economic forecasts.
How noisy are we talking?
Well, for instance, Customs and Border Protection reported just 4,601 southwest border apprehensions in July. That sounds like a historically low flow, right?
Very low, yeah.
But net migration is a much broader concept. It includes individuals arriving on various visas, those who overstay, interior enforcement actions, not just border encounters. It's like trying to understand the total water level in a bathtub, but only measuring the drips from one faucet.
Got it. So that one number isn't the whole story.
Not even close.
Yeah.
And even when the Congressional Budget Office, the CBO, slashed its 2025 net immigration estimate from 2 million down to 400,000.
Wow, that's a big cut.
It is, but it's crucial to remember that this is a projection riddled with wide error bars. These are educated guesses, not certainties.
Okay.
So while institutions like the Peterson Institute might calculate a precise break-even job number, say 50,000 or even below 30,000 with zero net migration, we should treat these as provisional.
Right. Handle with care.
Exactly. And here's why this matters for you. If that slowdown in labor force growth turns out to be real and persistent, it could become a significant growth headwind for labor force and potential output growth tomorrow, even if it seems to stabilize unemployment today.
So fewer new workers entering the economy means what? Slower expansion potential.
Slower expansion of the overall capacity to produce goods and services, yeah. So while the current job market might look stable because fewer people are joining it, the long-term growth potential of the economy could be diminishing. It's not just about today's numbers, but about the future runway for growth.
That's a really important point.
And this also brings us to a critical distinction. Is the economy truly re-accelerating or just showing resilience?
Good question. What are the signs?
If we connect this to the broader economic landscape, we see a decidedly mixed bag across different sectors. For example, the ISM Manufacturing Index, a key gauge of the health of the manufacturing sector, remained in contraction in August, hitting 48.7.
Anything below 50 indicates contraction, right?
Correct. Yet we saw services re-accelerate. That sounds positive, right?
On the surface, yes.
But here's the catch. Service sector employment is still contracting.
Oh. So activity is up, but the jobs aren't following.
Exactly. This combination clearly indicates resilience. The economy isn't falling apart, but it doesn't scream a strong re-acceleration or a robust growth runway.
So it feels more like, what, holding steady?
Holding its ground, maybe even in a holding pattern, rather than powering up for a launch. That seems more accurate.
Okay, what else should we be cautious about?
Then there's the lingering tariff fog that the article somewhat optimistically suggests has lifted.
The import taxes. I thought that was becoming clearer.
Well, the broad outlines of the import tax regime might indeed be clearer than they were a few months ago, but the legal outlook is far from settled.
How so?
We just saw tariff receipts hit a record of approximately $30 billion in August, which sounds like a significant fiscal win for the government.
It does.
However, various parts of this tariff program are still facing active court challenges. If these challenges are successful, they could potentially force substantial refunds.
Creating a huge fiscal headache down the line.
Precisely. This isn't just a niche legal detail. This kind of ongoing uncertainty is macro-relevant. It impacts prices for consumers like you, complicates global supply chains for businesses, and throws a wrench into the government's fiscal math.
So suggesting it's fully settled is overlooking a significant and potentially costly open question for the economy.
I think so, yes. And this raises a particularly important and often underemphasized risk: the Fed's political vulnerability.
You mean beyond just setting interest rates?
Exactly. The article largely focuses on the expectation of cyclical interest rate cuts, viewing the Federal Reserve as an independent actor guided purely by economic data.
Which is how it should work, ideally.
Ideally. However, the Fed faces a considerable political risk, exemplified by the administration's appeal against a court ruling concerning Fed Governor Lisa Cook's appointment.
Right, that case.
Rate cuts into above-target inflation, with core PCE and CPI still hovering around, 2.5% to 3%? That's already a delicate balancing act.
Definitely tricky.
But compromised central bank credibility, stemming from political conflict or interference, is an entirely different beast. Markets might shrug off a mild growth scare, or even a small miss on inflation, but they typically do not shrug off a hobbled, politically constrained Federal Reserve.
So if the Fed's independence is questioned,
If its independence or authority is perceived to be undermined, it could make dealing with another bout of inflation far more difficult, especially when combined with our current sky-high budget deficit. This adds a layer of vulnerability that needs to be acknowledged as a genuine economic risk for you and for the stability of the economy.
that's a sobering thought. Okay, so we've explored the arguments for economic resilience and dug into some of the crucial counterpoints. Now, what should you be watching next? What are the tells that will give us clues about where the economy is truly headed?
Good question. Where do we look first?
For starters, keep a close eye on the private demand pulse. We mentioned the Atlanta Fed's GDP Now tracker, which gives us that real-time snapshot.
Right, the one showing demand above 2% for Q3.
Exactly. It shows private domestic demand running above 2% annualized in Q3. If that figure holds steady, particularly alongside relatively flat payroll growth, then the slow grind narrative, that managed deceleration we've been discussing, really gains traction.
It would suggest a sustained, albeit slower, expansion.
That's the idea. What else?
Well, to build on that and to go deeper on the labor market, you'll want to watch those labor slack markers very closely. Right now, the signs are generally positive. The openings to unemployed ratio is near 1.
Meaning roughly one job opening for every unemployed person.
Correct. And the job quitting rate is low. Both of these suggest less wage heat, which is exactly what the Fed wants to see to keep inflation under control.
Okay, so what's the warning sign?
Here's what would be an early warning signal of trouble ahead. A slip below 1 on the openings to unemployed ratio, or perhaps more critically, a significant jump in continuing claims for unemployment benefits.
So not just new claims, but people staying unemployed longer.
Exactly. That would tell us that not only are fewer jobs available, but more people are staying unemployed for longer, which would be a clear red flag for the health of the labor market.
Got it. What's next on the watch list?
Tariffs.
Right. Tariffs pass through. We know those customs duties just hit record levels, roughly $30 billion in August. While that's certainly a fiscal cushion for the government, it's also a price headwind for consumers like you.
Absolutely. So where do we see that impact?
Keep a very close eye on the CPI for core services. That's the Consumer Price Index for services, excluding volatile energy, and the ISM Prices Paid Index from the Manufacturing Survey.
Okay, those will help gauge if tariffs are translating into higher prices.
Yes, they'll help us gauge any potential second-round effects on inflation that could impact your purchasing power. If those numbers start creeping up, it means you're feeling the bite of those tariffs in your everyday costs.
Makes sense. And finally,
Credit conditions.
yes, finally, we absolutely need to monitor credit conditions. The Fed's July CSL, or Senior Loan Officer Opinion Survey.
That's the one asking banks about their lending attitudes.
That's the one. It showed weaker loan demand and mixed lending standards. While standards were tighter for commercial real estate, they were generally flat for most households.
So Not exactly opening the floodgates.
No, this isn't a picture of banks eager to lend to fuel new growth and expansion. Instead, it indicates conditions that are more neutral to slightly restrictive, which could certainly impact future economic growth.
Right. If businesses and consumers find it harder or more expensive to borrow, investment and spending will inevitably slow down.
It's a subtle but powerful force that can dictate the pace of economic activity. Definitely one to watch.
Okay. So what does this all mean for you listening right now? This isn't just about abstract economic numbers or graphs floating around in some financial report.
No, not at all.
It's about understanding the underlying forces that directly affect your job security, the interest rates you pay on loans or earn on your savings, the investment decisions you make, and ultimately, the daily costs you face. Knowing whether the economy is truly resilient or just delaying a bigger adjustment can empower your personal financial decisions, giving you a clearer view of the landscape you're navigating.
Exactly. Recognizing these nuances allows you to move beyond the headlines and truly critically assess economic news. It helps you understand why certain news stories are important and how they might impact your life.
So it empowers you to make more informed choices.
Yes, whether that's contemplating career paths, planning your personal finances, or simply being a more discerning consumer of economic information, it's about being well-informed, prepared, and able to think for yourself in a complex world.
Well said.
So while the American economy shows surprising endurance, perhaps the true defiance lies not just in its data, but in its ability to navigate this complex mix of known strengths and less acknowledged vulnerabilities.
It raises an important question, I think.
Which is?
Is this a sustainable glide path into a stable future? Or are we simply delaying a more significant adjustment that could be waiting just around the corner? Something to definitely keep thinking about. Thanks for listening. Follow us for daily insights into world affairs. And don't forget to like, comment, and share.